So, big hands to my amazing guest.
I have my mic. Thank you. I have a mic already. Thank you. Thank you, Eva. Thanks a lot, Ivy, and thanks for the warm welcome. So that's me. So I'm indeed a senior partner at Roland Berger. I spend my time between Paris and Amsterdam. You might hear that I have a French accent, but I spent over 20 years of my life in the Netherlands, so I'm kind of Dutch a bit. Anyway, we are going to talk today about private equity in the digital age and how to create value also for the funds. And I will try to take the perspective of the private equity, of the tech leaders, but also the perspective of the advisors and what it means, what we currently see in the market, the developments, what it means for each of you, and what are the recipe for success, if I can dream of knowing them. Typically, what we do see, just a second. What we do see typically, so I'm going to cover actually 4 elements. We'll go through the European private equity landscape, what we saw in Europe last year. I will take a very European view, by the way. So I'm not talking about the US. I will talk about what happens in Europe, and we'll have some breakdown if needed per country. But we'll talk about what happened in 2024. We'll talk about what we start to see with our clients, to the funds in a nutshell, in 25. Then I would like to cover what we see in terms of the new playbook when we talk about software businesses and what is needed and what is the expectations of the funds towards the tech funders or the tech leaders. I will spend 5 minutes probably on what we call purpose capital or ESG, and that's why I said it's really not the US view. That is what we kind of see coming more and more in Europe. And finally, we'll talk about risk management because we live and we've seen that over the last 2 years in a big risk place. So, and that takes me actually to the downwinds, the headwinds that we see for private equity. So last year has been dramatic. So not everything is on the slides, but I will show you some graphs and something on slide. But what we've seen is really macroeconomic uncertainties all over the place, shifting geopolitical dynamics. You can talk about what happened in the US, the Trump administration. You can talk about US and China, US, Russia, you name it. Rising capital costs also have been on the agenda pretty much in 2024, and also inflation. And that all in all, this is a very challenging mix for private equity companies actually. And that said, if we are in this session today, we know that there is a lot of clout for private equity. I mean, there is a huge amount of dry powder, huge amount of committed capital. Whether it gets freed, that's a question. But actually the amount is there and the commitment is there. And there is also a massive impact of the private equity industry typically in the overall economy, much more than people who are not familiar can realize sometimes. That means that today there is a key question for private equities. It's really trying to answer, the question to answer is actually how to deliver this sustainable value creation in the future on the long run while navigating the prevailing uncertainties. And that's the magic question, or the question that everybody has on their mind. And actually, what we're going to try to talk about is some of the strategies that can be deployed by private equities, and in particular on the software industry, to deal with that and to make sure that sustainable value is being delivered. So I have 4 sections to talk about. The PE landscape, as I said, then we'll talk about the new playbook, the ESG part, the risk management, and then we'll try to understand what it means for all of you in terms if you have a private equity investor, if you're a tech leader, or if you are an advisor, and what are the different impact that this will have on you. So in terms of market, we saw that 2024, so every year actually Roland Berger is releasing a study. So we look at all the countries, but we also looked at official sources of information about the number of deals and release that. We also talk about a lot of private equity players in all Europe, who are typically our clients. What we saw in 2024, let me move to some data, is that 24 has been almost dramatic, I would say. So we saw a huge decrease compared to 2023. So that's the last line over there, the last column here. All the countries actually have been affected by a decrease of deals. Benelux, you see minus 6% in the number of transactions. France, minus 15%, so even higher. What you see on the right-hand side over there, it's really per sector. what you can see is that even the technology sector has been severely impacted. Now, that being said, some of the conditions that were behind that did generate those bad conditions. We talked about it on a high level. It was all the uncertainty at the macroeconomic level, but it was also reasons that have more impact on the private equity itself. And I will show you that very shortly. So that said, when we talk about 2025 now, we also talk to our clients to understand what do they foresee basically in the market happening, and what we see is really there is what I would call a cautious optimism for 25, and some of you will be able to comment probably, but so there is an optimism. We believe it cannot go lower. It has to get higher, but it's a cautious optimism. So majority of them tell us that they foresee an increase of a single-digit increase of the number of deals. And some are even more bullish across Europe, saying that it will be more than 10%. What you also do see here, and the picture is a bit different per country, you see that the Nordics typically and Iberia are pretty positive and bullish about the outlook. Typically, you see that for France and for the Benelux, it will be the picture will be a bit more gray, and when we listen to private equity players. Some of the risks that have to be managed, and let me go to the next one actually. What is typically mentioned by the private equity players as a risk that remains, and you see that on the right hand side, the overall economic situation. It's a concern. Hopefully, it's going to improve, and there will be further access to capital, but it is yet to be proved. And what we've seen so far at Roland Berger on Q1 plus 1 or 2 months. We see this kind of recovery, but it's not yet a very easy market, I would say. Valuation levels, that's also a very interesting point, because one of the things that was hampering the most actually the deals last year was really the gaps and expectations between the buyers and the sellers. So basically, when you talk about multiple, the misalignment between bidders and sellers and what would be the actual value of the assets that are put on the market. And then the additional part that is there to mention is also the finding the attractive targets, but that's also often, I believe, connected to the valuation and to how much the sellers are being pressurized or try to sell the different elements. Let me check if I forgot anything. Or maybe another point also that we can note also on the private equity side. It's really I think we have it on the next slide. And it's not there. But what we also see is an increase also of the operational cost, typically that is also putting a strain on the overall business plan. So when you talk about energy, so in tech sector, energy can be a topic, not per se in software, but typically in technology, the energy, you talk data center, it can have a big impact. Another impact also that is to be noted is also the availability of manpower, of the right resources, the right people, at the right cost or at the right price. And that is typically mentioned also by your clients. So let me go back in a nutshell to here. So what about the software sector, you might want to say? So there are still challenges. So there is a recovery, but it's like it's a blurred recovery, I would call it like that. But still, for the software sector, we do see that as one of the most attractive sectors, software and technology. And you have seen that in what our respondents tell us. This is one of the top 2 sectors actually where people expect to see deals and to see things happening. Also in 2024 and 2025, I mean, the software sector has had some relatively strong multiples. So the valuations stayed pretty high. The expectation it will be even higher. But typically what we've seen over the last year and a half is valuations in terms of multiples between 6 and 12 times the recurring revenues, annual recurring revenues, which is relatively solid, I would say, in the software part. If there are any question, by the way, or anything, please don't hesitate to interrupt. that takes us to the next part, actually, how to build a future-proof value. So in the past, valuation on software, they were mainly done looking at a number of things. The usual suspect is revenue growth. So typically, the portfolio companies or the tech founders, they were really pushing on the revenues to get the revenue growth and to grow, basically to get to play the multiple gain. And for private equities, so it meant also pushing, once they acquired the assets, it's pushing on the revenues. It was also playing the multiple game. But that's really a recipe of the past. What we do see nowadays is that there is a big shift and a big focus for most of the private equity funds we work with on operational value creation. So there is this rule in software as a service, which is the rule of 40, which is sometimes mentioned by some of my clients at least. And it says typically if you take the profit margin and the growth rate, the sum of both should be more than 40. What we do see is that the profit margin part usually, for many years, was not so much on the agenda. Now it is on the agenda, and the old games of leverage and whatnot, it doesn't work anymore. You really need to work on how you are going to deliver basically the performance, your operational performance improvement, and how you are going to manage your cost in an efficient way. The strategic lever for success is, and let me check because I'm missing one paper, which is probably somewhere. So that takes me to the second point of the section 2, what strategic levers that we do see. Well, the number one for private equities and software company, the number one is about digitalization. So really harnessing the power of data for operational efficiency, to build a better customer understanding. It is critical. It is critical. Everybody talks about it, so it's not a spoiler alert, I would say. But that being said, in order to be able to deliver that, you really need to have a very robust data strategy. You will need to have very robust governance processes also in place, and to be able to leverage the power of of analytic capabilities. But that's really the number one element that also our clients are telling us, and I'm sure that it is mentioned somewhere. You see that here. When we talk to the funds, to the funds across Europe, digitalization, data analytics, it is mentioned all the time as one of the key levers to increase value. And I'll talk about add-on acquisition a bit later. Then we see all sorts of elements on cost reduction initiatives, but also operational efficiency. So development, for example, of code writing development, software development. This is also a key element that is mentioned often. We also see some of our clients mention huge efficiencies, 20 to 30% sometimes, of code writing, so code development and software development using the new technologies that are becoming available. The second element is AI integration, and that takes us to the next part here. And AI integration, so we've seen a tremendous rhythm of new technology. AI is not so much new, but it's no more a buzzword. AI is coming, and it's coming also in all the portfolio companies. What we can say on that is that it has an impact for private equities, but also for the portfolio companies. On the PE part, it's really about the way the funds are being managed, from deal sourcing to target screening. There is a way to optimize and to be much quicker and to find the right targets. But also another element which I find interesting, and we'll talk about that, it's the due diligence process. Also in due diligence, funds are using more and more AI to assess and to analyze a vast amount of data, of reports, contracts, you name it. That is being done, and that is pretty efficient actually. That's on the P part, on the fund part. Then you have another leg of that, of course. That's really what we call the portfolio companies. So AI is really there to make an impact on the way the different companies are being run, running across the value chain. You can talk about pricing algorithm, or how to make a better pricing, to how to run your supply chain more efficiently. You can talk about basically all the process. I was talking about development and coding. This is also impacted by AI. So all the portfolio companies also in software are being impacted and are becoming more efficient. Or there is there is ways to make it much more efficient. There are ways to make them much more efficient. If I go back to my to the various points I wanted to take, in terms of strategic levers, yeah. So in terms of levers that are mentioned, so I told you and that I would come back on that. There was an element on add-on acquisition. When you talk about add-on acquisition, also in software industry, you also talk about due diligence, which is over there, and that's where both are coming together, because actually the way to make it work is to have, let me do it like this, a much more solid way to do the due diligence, or to do what we often refer to digital due diligence. And typically, what we do see is that the way we do it actually at Roland Berger is that when we do due diligence, we look at the digital strategy of the company, and that's one element, but we also look at the more commercial due diligence aspects when you look at the platform. So we're going to comment and to look at the market positioning, the competitive positioning also is going to be covered, and the way to engage with the customers. Putting all that together, and of course, sometimes we do that on our own, sometimes we do specialized boutique like SAG, for example. We are also going to comment on the underlying technology that is enabling the whole business model. And what our conviction is that you really need to bring that all together. So doing due diligence in silo, of course, you will have the financial DD done by the auditors, but doing the silo part no longer works. You really need to connect the whole commercial / strategy part along with the technology part to be able to assess not only the maturity of the software companies, but also the viability in the long run. And let me check. Oh, there's one point that I forgot to say, but I want to say it because it's an interesting one on the operational value that I mentioned. So I don't know if it's something that everybody knows or if it's a surprise. So really the profit margin. What we did some analysis actually at Roland Berger about past deals. In the past, most of the value generated by the deals at the moment of the exit was coming from the revenue growth. So more revenues, more users. That was really a key driver of the value. A bit less on the multiple. And what we did see is that between 5 and 10% max tops was really coming from the operational efficiency gains within the company. That's really the story story from the past, and also all the investors and the funds tell us that now you need to get both the top line, but you also need to get the operational efficiency to run your business across the value chain from code writing and so forth in a much more efficient way. Okay. That takes me, and it's a lot of I'm doing a lot of talk. Indeed, I realize I'm good on timing. Yeah. That takes me to the purposeful capital and PE as a forces of progress. So this is a bit pushing it, and I know that, but I still want to say, and this is really not US relevant, because I know when you talk ESG and sustainability in the US, it's a different ball game, and people don't always agree, or sometimes strongly disagree. But what we do see, and let me take my notes also, which is here, is that ESG more and more is also seen also by funds, and I would like you guys to comment after, but as a source of value creation. Probably not immediate, but it's also a social responsibility to do that. And you can ask me, and you can wonder, how? Why is it the case that much? Well, for a number of things. The number one, across the deal continuum actually, and also when you run in the portfolio company, or if you want to acquire some young talents in a fund, more and more people are asking to have a purpose. And Gen Z, for example, so I'm not sure who is Gen Z in the room. I haven't said anything to be nice. I'm not. But Gen Z, they need a purpose. They need to work for a company that they believe the credo, and they believe where it's going. So attracting the talents, and talent is a big issue, not across industry, but also in software. Attracting the right talents some often means to have the right people, and the people who believe in what you're doing. So that's to have a purpose and to work for a company with a purpose. That's one topic. So to be able to run the operations. The second element, also for private equities, it's about getting the funding. Typically, whether it's a bank that has to provide some of the funding, or whether it's rich individuals, more and more people are asking for sustainability elements. So why should I invest in there? Does it make sense? And is it future-proof also in terms of societal impact? So that's the number one. You can get potentially cheaper or at least get access to funding. And the last element, I would say, is that at the moment of the exit, 3 to 5 to 10 years now, because we see some durations increasing, at the moment of the exit, you have the risk or the chance, depending how you see that the buyers also are going to value more businesses, also software businesses, which are more sustainable in a way. And that takes me, so what about software then? Can we talk about ESG and software? Can we? Maybe?
It's not important according to the list.
Well, but according to me, it's important. Let me tell you why actually. First, because on the software part, on the tech part, I mean, you guys, you have your own footprint already, your own ESG footprint. And when you talk about green IT, for example, which is becoming a real topic, if you talk about AI compliance, if you talk about data privacy, there are elements that, and software companies need to comply with some or have some ESG footprint, and that should not be underestimated. The second element for me of software is that it also has the ability to create a real impact in the society. Yeah? So what you can think about here, and maybe sometimes, many times people don't see that, but actually when you think about it, it makes a lot of sense. At least to me, it does. For example, you can talk about ESG score tracking, so how to track, how to follow scores, follow CO2 and so forth. Software are there to improve on that one, and there's some software who do that. If you talk about healthcare, you know, enabling patient access, giving more access to healthcare to patients, software, the right software has the possibility to do that. If you think about it, the example are countless, and you should think that the whole industry, actually all the companies around you, they need software, and they all have an imperative to, or most of them have an imperative to play a role and to have an ESG role. So it's a real potential for positive social impact, I believe. If we talk about the next part, that I have here in number 4. So how to manage risk going forward. I'm not sure if somebody has the solution or the magic solution, but typically what I would say is that the risk environment has increased significantly last 2 years. We can talk about microeconomic risk. We can talk about geopolitical risk, technological risk. You know, risk to become not to be on the right technology in the future. We can talk about regulatory. I talked about data protection, for example. AI. How do you deal with AI? It's becoming more and more complex day by day. You even get the tariffs now that came. So after tough 24, now the tariffs came. And some of you might not consider the tariff as a big issue for software. At least at first sight, it's not a huge issue, potentially. We think more about companies that manufacture stuff that have to ship them to the US and so forth. But actually, those companies, whether you talk automotive, OEM, whether you talk suppliers, whether you talk steel manufacturers, or whatever goods anyway that are being produced, those companies are your clients. They are the clients of the software industry. So ultimately, you know, there are underlying markets for you and underlying clients, and that means that if they are going to suffer, there is a chance that the software industry is also going to suffer by extension. That was about the tariffs. So what does it take then? So the risks are increasing. That's what I just said. The tariffs doesn't help. It's not a big issue. It's not a huge issue at first sight, but for sure it's not helping. So what does it mean actually in those risks for the software industry? So if we are a bit more granular there and we go one level deeper, typically we can talk about cybersecurity and in the valuation and so forth. You guys are at the forefront of cybersecurity. You need to make sure that your solutions are completely secured. There is the risk that we discussed a bit before of technology obsolescence and the risk of falling behind and being disrupted by new technologies coming. There is another risk. We talked about due diligence and M&A, so inorganic growth. There is a real risk of integration. So how do you buy your private equity? You want to do some buy and build. You buy 2 software companies. So how do you integrate that and which platform do you select and so forth? This is not easy actually. And of course, there's all the regulatory risk, you know, from like data, GDPR, you name it. AI ethics and compliance. That means that to be able to do that going forward on the risk part, you need to have a dynamic way to deal with the risk. Risk used to be merely a compliance stuff. No, it's compliance. You do it once every quarter. You report to the board or to the leadership, and this is done, and you cover it and check, and you move. Today, things are moving so quickly that there has to be ways to manage risk in a way more dynamic way, in a bit more intelligent way to help steer the business and to be fully aware of what's coming next. If we talk about software industry, if we talk about AI or new technology, quantum computing, whatever, you need to be ready because things are coming. So either you're part of the solution or either you're not. But then you have an impact on the valuation and on the long-term value creation that you will have. So that takes me actually, we're good on timing, Ivy? I'm looking.
Yeah.
Okay, so maybe for the conclusion, so that's my part number 5. You're charting the course. Well, typically, what I would recommend to my clients, whether they are private equity or tech leaders, or to my competitors, or internally at Roland Berger. So basically, what we say is that they need to embrace operational value creation. It's profit margin. It's not just revenue growth. You remember, it's also profit margin. That's number 1. Number 2, you need to leverage AI in a very strategic way. So know what's coming and know to what extent it might disrupt you or not. So for example, if you are in a content generation or if you have in workflow management, what does new AI or new product or new technology mean for you and for your business? You should think twice about it, because if you go through a due diligence and if you undergo due diligence, the investors will think for you. The third element is integrate ESG in a holistic way, because that's important. And the last one I would say is manage also in a dynamic way risk, because risk you shouldn't be surprised by risk. You should manage it also in a very proactive way. And of course, get good at digital and digital due diligence, because you will have to go through that one way or one other. So maybe for private equity investors, what does it mean? Well, I would say it's refine your software operational playbooks. I would say invest smartly in your own AI capabilities, and embed ESG deeply in the business practices of the way you manage your funds, but also potentially, if it's not disruptive, at your portfolio companies, and strengthen your risk management. If you are a tech leader, and we have some people in the tech part here, I would say focus on sustainable and profitable growth. So you need both in terms of valorization, and get ready for intense due diligence when the moment comes, because you will be scrutinized, and it's not always super nice. And also understand what is the impact of AI in the very short term on your business and on your value proposition. And for M&A advisors, I would say 2 elements. It's adapt your due diligence process to what we just said before. So having an holistic view, not only from the tech part, but also from the whole market and platform part. I would say understand all the drivers for valorizations are changing, for valuations are changing. Sorry, in English, for your clients, and get ready to help your clients in terms of valuation gaps, but also for their complex integrations. That's it. Thank you. I'm happy to take any questions, if any.
Thank you so much. A big hand.
Thank you.
We do have some time for 1 or 2 questions. Would someone want to raise? Yeah.
So based on your interviews, the digitalization is the most important value creation item. So in your opinion, what's the most important part of the business that you should digitalize? What creates the most value?
Oh, that's a tricky one. So what I was telling us, so for many years, also in software and then SS sector, it was all about the revenue growth. So getting the revenue growth, latmar of the margin, but just try to grow. So more and more, it's really about opening the hoods, let's say, and really making sure that you are also efficient inside. So I would say, look at your back office processes, look at the way you develop also your code, and you develop your new products that you bring to the market.
Right.
Yeah.
To this question, so basically you're saying how digital you are as your own operational organization. You mean?
Yeah,
Not with
precies.
your product offering, but in your processes and in your.
And how you develop also your new products. Huh? So AI is coming, it's helping. What are the risks also associated to that? How do you make sure that it's not everything is not leaking? And how do you make sure you still ensure the right quality of the code you're going to write in developing your products? All those questions which are complex.
Yeah.
I know. Yeah.
Okay.
I use the contribution margin. It's because that takes into account either more sales or lower cost, and that would determine the ranking of the backlog of
Yeah.
software.
Yeah, makes sense. Absolutely. Yeah.
Okay. Thank you.
Yeah,
I think
that
we
was
have
my
another.
Yeah, thanks.
Yeah, I had a
Mr. Bishak.
question around this whole age of AI and data. I spent a few weeks in the US, Silicon Valley earlier this year. And one thing I felt that a lot of European companies are being held back because of very strict data laws here. Do you also see the same? Because OpenAI wouldn't have been OpenAI if they had not trained in on all data, which was maybe not totally ethical. But do you feel the
The
same?
fear of data loss? You mean
Fear of data laws? Yeah.
Or sharing confidential data? Is that what you mean? Or
More in this context of AI, are European companies, industries being held back by do you feel, what can be done about it? I'll be first. Is it an issue, real issue with European companies? Usage of data to train AI models to use more AI?
So what we do see generally, and there's no news, and all the technology advancements. I mean, Europe is 5 years behind the US. So US, if you tell me that US companies are much more advanced and much more progressive, I'm pretty sure that is the case. We also see that. So when we talk about actually public companies, so stock listed companies, this is a real issue. So across sectors, we see there are some negative war stories. So for example, if you take Samsung, you know that some people leaked by mistake their overall business plan and business strategy, and then they became the running joke. And companies in France and typically in Europe are very scared of that. So they tend even to restrict their users using AI, and they still wonder how to take it. When you talk about privately held companies, so typically portfolio company of funds, here we see much more acceleration because there's much more decision-making process is way quicker typically, as long as you can prove that there was a good case. What I've seen my clients when I still used to work for Accenture, I saw EQT was very progressive actually, and they were moving a lot on developing in the portfolio companies AI solutions to improve back office systems, tools, and whatnot.
Okay. Thank you so much.
Thank you.
Yes.